So I want to welcome everybody. This is our first annual HOA Bootcamp that came about through this conversation with my partner from San Antonio, John Buckway. Our goal here is to give you some tools, give you some guidance, be a resource to you with your HOAs and your condominium associations. I do want to thank several people. I want to thank the Tiki. That's where we're located right now. I want to thank our marketing team at Haney & Company. They did a great job of putting all this together for us. I want to thank my partner, John. He and I collaborated a lot on this. Our IT guys. There's a lot of people that help put this together. But I also want to thank you all who serve on HOAs and on condominium associations, because I know this is often a volunteer, extra time away from your family. To take care of the community. So thank you for the work that you do. Feel free, if you're in this room, feel free to get up anytime. The facilities are in the back. There's plenty of food. Make notes of the questions you might have, because we will have Q&A after each session. But we hope that you're able to take some tidbits back to your HOA and help improve the way you all are running. So our agenda for today, we're going to have 4 different speakers. Am I going to have a clicker, or are you going to have a clicker? Okay. Just so we're not like, no problem. We're going to start off learning some insurance basics, and then we're going to have attorney Kathy also talk about 4 duties. They'll go into details on that, and then John will cover the HOA financial essentials, and I'll end it with the tax essentials. So I know Wade has to get going, so I'm going to get him started. We go way back. We graduated from the same high school just a couple years ago. I know even back then he was a smart, brilliant guy. So I'm happy that he was able to make it and to join us today. So I'm going to turn it over to him. Let me make sure I know how to use this.
Well, you can keep it in your hand because I do not have a PowerPoint.
Okay. Well, I just wanted your name.
Not brilliant enough to do a PowerPoint, that's for sure. Good morning, everyone. I know that Saturday morning insurance discussions not at the top of anyone's to-do list, but just 45, 50 minutes, I'll have you out of here, no problem. Actually, closer to 5 minutes, but let me tell you real quick about me. My name's Wade Sales. I'm one of the owners of Bob Sales Insurance Agency over in Brownsville. We've got a location in San Antonio and in Bernie as well, under Independent Insurance Center. That's our agency name up there. Our agency started in 1924, so we're completing our 100th year of serving the Valley. Our family has been running it for 58 years, and this is my 35th year in the agency business. And one of the things we have tried to focus on, the Valley is a very unique place. Cameron County, even more unique. South Padre Island, even more unique. The Laguna Madre area, Laguna Vista, Port Isabel, Rancho Viejo, Brownsville. Condo associations are a huge feature of the insurance marketplace. We've tried to focus our attention on, having a little bit of expertise in the condo association insurance field. What we've done is we've probably over the last 8 to 10 years, we've written about 70 to 80 different condo associations and tried to help manage them, manage their insurance focus. So all I wanted to do is go over a couple of quick little things regarding condo insurance, condo association insurance that I think would be helpful to anybody that's on a board. Honestly, the success of a lot of condo associations, you're going to hear this from, I'm sure, the other speakers as well, is having a strong board is so crucial. I know it's a volunteer position, but being on the board, it's so valuable when I see condo association boards that are involved, that want to come to my office and sit down in the conference room and go over stuff. There's a tendency to just well, I'm sure it's all going to work out fine, or I'm just on the board because I didn't have anything else to do. This is a pretty serious operation when you get on a board. Another thing is, if you feel that, I want to have everybody know that whether it's our agency or another agency, the agents and the employees of that agency are there to help guide you through this. Not everybody can be an expert in this type of stuff. So I think having some willingness to go and talk to your agent or go talk to the employees there is something that every board member should feel comfortable doing. And if you can't get an agent to come talk to you, I would think about looking around. No, I think this is what my job is. My job is coming to talk to people and trying to helping people out. Anybody can write a policy, but somebody's got to be able to help you kind of decipher what's going on. Another thing that the board, I know that is one of their constant things from an insurance perspective, having some sort of a continuous and constant maintenance program is crucial to getting insurance carriers interested in writing your association. We've got a lot of development in Brownsville. There's a lot of development on the island, but there's a lot of buildings. The Tiki is a perfect example of how it has been kept in such great condition. Buildings were built in 1973, 1974, something like that. Yeah, 50 years old. And if I, as an agent, go to a company and go, hey, I've got a 50-year-old complex that's 300 yards from the ocean, and they go, well, yeah, thanks, but no thanks. But then they see the maintenance program. They see how the pride and ownership that the board is the leader. They're the leaders of the members. But if you can get as many people involved, that really makes a huge difference from an insurance perspective. Now, there's plenty of other great things about having a continuous maintenance program that I'm sure everybody likes to help preserve the asset that they've spent all this money on. But from an insurance perspective, it can't be emphasized enough how important it is. The main issue everybody always asks me, how come insurance costs so much? How come the price keeps going up? We got a bunch of unique situation here in the Valley. We're on the coast and we're on the border. Neither one of those things are at the top of any insurance company's list to write. We have windstorm issues, hurricane stuff. If you ever watch the Weather Channel during the summer, you would think this place is underwater half the time. And it's not, but perception is a huge aspect of this. I never have understood why an insurance company that says, well, we'll exclude the windstorm, but we still don't want to write anything else. This building is no more likely to burn down than one in San Antonio or Lubbock or Dallas or the middle of Kansas. But the windstorm and hurricane exposure is a big deal. Anytime maintenance is done, I've talked to the people at the Tiki and talked to all of our customers. You have to get a windstorm certification on everything. So if you ever have a roofer that comes and says, we're going to put a new roof on your place, got to have the state mandated windstorm certificate for anything that's been done since 1988. That's been a rule. So any changes to the exterior, any re-roofing, redoing all the sliding glass doors going out to the porch, redoing your windows, all of that, there has to be a windstorm certificate. Every contractor knows it. Most all the cities in their permitting departments require it as part of getting a permit. And the only problems we ever run into is when somebody hires a guy from down the street and he does it in the middle of the night or he does it on the weekends and doesn't go get a permit, and then there's no certificate, and then the insurance company won't write it. So, I mean, that's just a little thing. Another thing that we've seen about prices of insurance within the past 3 to 4 years, and you all have seen this, is inflation and just the general economy. What has happened is, if you ever gone into the Home Depot 4 years ago and bought a sheet of plywood, it was $19, and now it's $65. So when you're trying to replace or repair a building that's been damaged in a hurricane or damaged in a fire or damaged just in general, the cost to replace, the replacement cost value of your buildings have all shot up quite a bit in the last 3 to 4 years. And one of the problems is maybe your insurance values on the buildings have not kept pace with the current economy. So again, this is a thing. You have more insurance, premium goes up. So this is not even a rate change. They could be charging the exact same rate. And if this building in 2020 cost $500,000 to replace, it might be $800,000 now. And your agent and the employees of that agency and the board should be discussing these types of alterations to the policy. It's unavoidable that the premium goes up when you buy more insurance. It's just, that's the way it is. But one of the biggest issues we have seen, and this is the kind of the main thing I wanted to touch base on, lender requirements, mortgage companies, banks, and I'm sure they'll talk about this later on after me. We have seen condominium associations and boards refuse to raise the values because they don't want the premium to go up. Somebody that owns, unit number 25 in that condo complex wants to sell it, and somebody wants to buy it. And a lender comes in and says, these buildings or this complex is underinsured according to our lender guidelines. I have no say, and my insurance company has no say in what Bank of America's rules are, or Wells Fargo, or whoever. They come in and say, we're not going to loan money on this until this coverage has been increased. We had a board in Brownsville that the lender came in and said, well, it doesn't have this endorsement on the policy, which had never been a requirement before, but it cost $1,800, let's say. And the board said, well, we're not paying for that just because this person is selling to somebody who's using this lender who has a requirement that the whole association carry this type of coverage. Said, well, we're not going to pay that for that. We're just not going to do it. I said, okay, well, I'm going to send you a letter that says y'all have said you don't want this. Within 24 hours, an attorney for that buyer or that seller of the condo unit had sent a letter to them and to me saying, we understand that you don't have sufficient insurance and you have caused our sale to go away. It fell through. And we don't think that is right. And we think you're causing us financial harm. And we would like you to reconsider this. And so I sent that in I called the board and I said, hey, I got a copy of this. I'm sure y'all did too. And they turned around and said, yeah, we think we need to add that endorsement to the policy, which we did. I send a letter back and say, obviously, this was a misunderstanding. And of course, the board has decided to do this because we don't want that deal to go away. Of course, we want to take care of all of our condo owners. It wasn't that the board had done anything wrong and we hadn't done anything wrong. It had never been a requirement to have this special endorsement on these type of policies, but it is that way for some boards. We had a deal with Wells Fargo has a problem that they won't write or they won't loan money if there's not a crime employee dishonesty bond packaged with the insurance. And I was like, well, what difference does that make? And they were like, well, Wells Fargo has said that if a condo association doesn't have an employee dishonesty bond, what if one of their employees embezzles X amount of dollars from the reserve fund and then something happens and the association doesn't have the funds to do these repairs or whatever it is. So all that said is lender requirements can be a huge obstacle if you're not in communication with your agent. If you're as a board, you may want to mention that to whoever your agent is. I think that's probably sure.
Oh, sorry, just whenever you're done.
No, go ahead.
Just what are some of the required endorsements you're seeing in this area?
There's one called the Increased Cost of Construction Endorsement, or ICC. And basically what that means is this building, let's say this building was built 50 years ago and it burns down. The insurance company is obligated to replace it the way it was. Well, they can build it to the standards of what it was 50 years ago, except in the meantime, there have been building code improvements and city ordinances and all of these things that say, well, you can't replace it with a window that was valid 50 years ago. The windows that we have now is double pane this, and it's withstands 100-mile-an-hour winds rather than 50-mile-an-hour winds, and it's debris resistant and shatter resistant. Whatever the rule is, that costs more money, and theoretically, the insurance company is only obligated to replace what you lost, not this increased cost. But we have an endorsement called the increased cost of construction endorsement that can be added to a policy and provide you this additional coverage that instead of having 4 nails in a shingle on a roof, you have 6 nails now. And if you have, instead of 12 hurricane straps on the trusses, you have every single truss has a hurricane strap on it. So it's just the cost of construction that's better than what you had lost is what this endorsement covers. For years, it was an option, and it's still an option. It's not mandatory on a policy to purchase, but Wells Fargo was making it a mandatory for any policy that they, or any loan that they had on the books when it came to condominiums. So this is that's one of the endorsements that I can tell you. The crime employee dishonesty bond, that's another one. The basic ones are just like any mortgage that you've ever had in your life. If you owe $200,000 on a building and you only insure it for $150,000, the bank is the one want to have at least enough coverage to cover the loan. But those are 2 of the big endorsements that I've seen recently. So lastly, I'll wrap it up here and let y'all, if y'all have any questions that you want to ask me, that'd be great. I did want to mention about answering questions in a group setting. Insurance is there can be some general rules, but everybody's situation is unique. Everybody's condo complex is a different age, a different size. You got high rises and you've got fourplexes, and it's just, there's all sorts of different things. I'm leaving some business cards here that have all my contact information on them, and please take as many as you want and hand them out. If you have any specific questions about your association, you can always call me or email me, and like I said, I'm more than happy to visit with anyone about it. I guess the last thing I was going to mention is really, I want to really emphasize the idea of finding an agent and an agency that you can trust and that you can talk to and that you can ask questions to. Anybody that does, I'm not the most comfortable guy up in front of a big room talking to anybody, but I feel like it's part of my job to try and help educate and try and help explain the situation as best I can. And, I started with my dad in the agency, and I spent 2 years going to every meeting with him and not saying a word and just sitting over in the corner and listening to him talk and him answer questions. And one of the things he kind of taught me when I was 23 and dumb and didn't know anything was, don't be afraid to say, I don't know the answer to that question, but I know where to find it. And I don't know the answer to every question, but I can promise you I know where to find it. And, I think there's a lot of people that have a tendency to answer when they maybe aren't sure about things. And there's nothing worse than a board that's relying on quote unquote expert advice when the person doesn't really know what they're talking about. Find an agency that you're comfortable with. Find an agent that you're comfortable with. Somebody that you can trust, somebody that will meet with you, somebody that'll talk with you, and somebody that not afraid to say, I don't know, but I know where to find the answer. So if anybody thank you very much for having me here. And if you have any questions, I'm more than willing to try and answer them. And if not, like I said, I'll leave my contact information here, and you guys, what can I help you with?
Got plenty of questions.
Okay.
Don't move.
Got it.
Well, I know that you say insurance and you say that in a singular verbiage, but really, when you start talking about underwriters, it's more than, it's probably about 6 underwriters plus TWIA.
Sure. You mean like the different types of policies that we're looking?
Policies the board puts together, it's about 7 total.
That is
The only
correct.
thing that is constant is TWIA. Everybody has to have TWIA. So I think we're on the same page there.
Correct.
Now, question is, what is the timing? I want to do a comp. I need a comparison because I got to do my due diligence for the condo
Sure.
owners. Even though we've got good insurance, we've done all this stuff. What is the timing? Because every time I call, they say, well, you're too late or you're too early.
Okay.
And my understanding also is if I have an insurance agent over here and they're already connected to 6 underwriters.
Sure.
Okay. And I go to old sales over here and he says, yeah, I'll look around for you, but he cannot use those 6 underwriters.
The standard practice to answer that question is the first agent. Agents are appointed to multiple different, what are called general agents or insurance brokers or insurance carriers. It could be to that level. The first completed application that is received by that company is obligated to send their quote to that person. So if you call me and your insurance is coming up in a week and a half, and the other agent that you currently have has already submitted 9, 10, 12, 15 different applications out and what's called blanketed the market or blocked the market.
Right.
They are getting 12 to 15 different quotes in theory from all of these different carriers, and I do not have access to those carriers. This is one of the issues with living along the coast or living across the border. There is a very limited marketplace of who's willing to write quotes. So to answer your question, I would come to you and say, I don't have a market. I have 10 markets, but they've already all received applications from the existing agent.
Because my agent, every year, are they keeping the same underwriters? So those 6, or are they going out for a blanket again?
They can. I don't know what their position would be. If we have shopped it the previous 12 months ago, let's say,
Right.
and found the best market, unless there is a huge rate increase by the existing one, we feel like within 12, things haven't changed that much in 12 months that we would send out 12 new applications and block the market again in order to just keep the one company. I think this goes back to trying to find an agency that you trust is giving you the.
Okay, so what is the second part of that question? What's the timing? When do I call sales and say, hey, look, I'm shopping around?
I typically love to have 90 days to get all.
You like it or?
I like it. The insurance company typically will not give you a quote that they will guarantee longer than 30 days. But I like working with my underwriters and my brokers and have the time to gather the information I need from you. Because if it's a strange account, I want to go pull every piece of data I have. You're going to order loss runs from your current carrier. And then we submit all of that to our best 3 guys, let's say, and we'll submit it and I'll try and get something to them. I like to do it 60 to 90 days in advance so that the underwriters have time to go to the different carriers and send it to quoting, send it to whoever. They'll do their due diligence on their underwriting, see if they've ever written it before, that kind of thing.
Okay, so one last question.
Sure.
I know in a lot of cases, April 1st. Oh, it's the magic day. We got to have all of our money in, all the money in for sure. And we don't know our total until about 2 weeks before.
Right. Very difficult
It's not
to-
your fault.
No, that's
It's
right.
nobody's fault, but you got, so what do you suggest on collecting from the owners?
Okay, this may be a little more of an administrative thing from a property manager standpoint, but I have seen it done two different ways. One, the property manager or the board or whoever's in charge of collecting the monthly dues starts building in an insurance supplement into the monthly dues to be collecting it throughout the year. And that way it doesn't hit everybody all at one time. The dues are going to go up if insurance is not already collected in the monthly fee that is charged every month. But it is also, it's not a perfect solution because let's say it was, I don't know, let's say the insurance for everybody was $1,200. So it was $100 a month you've been collecting. And then when your agent presents you the quote, really you needed to be collecting $1,500 instead of $1,200. So you send out a supplemental invoice for the, whatever the difference was, and everybody has to give you a check for $300. I have also seen where there are separate insurance assessments, for lack of a better term, where 2 weeks before the renewal date, you haven't collected any insurance and everybody's got to fork over $1,200 to have it in the pot. And like you said, hard to collect it all in 2 weeks. Right? If you, Tiki's got 144 owners, hard to
That's
collect.
pretty standard as far as 2 weeks, 3 weeks before.
I would say yes. I don't think anybody is giving you, or I would like to think that unless I was approached 10 days before renewal, that I'm giving everybody at least 3 weeks as their notice. That 20 to 30 days before your expiration date is kind of our magic period that we want to begin, because I don't want to ambush anybody with a rate increase right at the end of the policy term where they can't go out and shop it. When I've seen this last 3 or 4 years, what's happened to insurance rates, I'm letting my customers know a month, 2 months in advance. Look, this is what we're seeing in the market. This is what other similar accounts that we represent have seen. If you want to shop it, that's great. But I'm just giving you a little warning, a heads up that this is what's getting ready to happen. So, and like you said,
it's too late.
If I tell you that,
Yeah.
if I tell you that a week before expiration date, yeah, it's too late and you've kind of been ambushed and where else are you going to go? That's also, I've never seen a company or I've never seen an agency keep an account when they ambush somebody at the end of the expiration date. I've had a lot of people that I've had come to me that said, I'm not ever going back to that guy because he came in 2 days before the policy was expired and the rate went up 50% and we didn't even know it was going to happen. So I don't know. And maybe that agent kept it for an extra year, but he wasn't going to get it back because again, those people didn't trust him going forward. Now, again, these are anecdotal stories. I don't know that this is a universal type of truth, but I never have felt good when I went to go try and buy a car and a guy told me over the phone it was this price. And then I get in there and all of a sudden it's $2,500 more expensive than he told me over the phone. But he thinks because I'm already there, I'm going to buy it. Even if I had to buy it, I'm never going back to him and I'm going to tell everybody else I know about him too. So again, this is my opinion when it comes to trying to be customer service friendly or being somebody that's trustworthy. This is why I kind of emphasize this as much as I have, that your most trusted agent, he may not be the cheapest price on the block every time. But if you can trust him that he's giving you the best option that he has available, then I don't know, that's worth something to me. Or something to me as a consumer and as an agent. So. Yes, ma'am.
How can you tell us what your underwriters are?
Oh, you mean like the different companies that we represent?
Yeah.
Oh, well.
Well, they are the same.
Well, there a lot of those brokers, a lot of those general agents. There's companies like Quirk and Company in San Antonio, or Hull and Company out of Houston, CRC out of Dallas. These are general agents that have representations with hundreds of different insurance companies, insurance carriers. Lloyd's of London, of course, is, been around 350 years, and they are kind of a catch-all clearinghouse for insurance companies. And a lot of people probably have their policies on the island written through a syndicate of Lloyd's of London. Lloyd's of London is one of those huge companies, again, been around 350 years, that started in a room like this, probably, where guys that were shipping goods out of London to Spain and needed somebody to provide guarantees for their cargo. And so that's how this stuff all started. So they have a syndicate where they will say, I'll take 20, they'll get one insurance company that will do that. So,
Not from the island, but from Brownsville. Would you be willing or able to give us a quote?
I'm always willing and able to give somebody a quote. No, we write business all over the state. So we write business, and our home office is in Brownsville. And so, yeah, we write condo associations in Brownsville. Like I said, feel free to pick up a business card and contact me anytime. But yeah, we'd love to do it. Anytime somebody's interested in shopping it. If nothing else, you get a chance to look at our quote and see if the current quote you have is good, which that happens a lot too. Somebody, you look at yours and go, yeah, our agent's doing a good job. Sales couldn't beat them, so we stick around. So we provide that service too. So anybody else? So yes.
So that's interesting that once you're essentially claimed by some associate or some agency, you don't know you have been. Was there some sort of liability or waiver that would have been signed by the association manager saying, okay, you're our group and the others can't bid on you? And then how do you unhinge yourself if you're not happy with that relationship?
That is a great question. And this is something that a lot of boards face is, let's use that example of where the other agent has sent out applications to 15 brokers, and I come back to you and I say, I don't have a broker because everybody is blocked.
Agent A had
done all of that. If you really want another quote, if you really want another agent to kind of be a little checks and balance on the other one, you can sign a letter. I can present you with a letter called an agent of record letter or a broker of record letter. And basically that letter says, look, for company A, I know you already received an application from agent A, but I want agent B to get this quote. And that company will respect your wishes. So you sign a letter saying, I want sales to have company A's quote. You can leave companies 2 through 15 with that guy, with the other agent, but I come to you and I say, well, I really think that's the best company and I represent them also. And if you really want us to be the agent to give you that quote, I just need you to sign this that says you're giving permission to that company to release the quote to me instead of the guy that sent the application.
Does company A know that you've done that?
Oh yeah, well, the other agent will know because that company will call that agent and you better be prepared for agent company A or agent A to come back to you and say, hey man, they just sent a letter to me saying that you have signed an agent of record letter to get another quote. And you can say one of two things. You can say, oh, well, I didn't know that's what was going on, and I'll sign a rescinding letter and give it back to you. And then he sends it in and they give the quote back to him. We try and not do that because I don't like, I don't like doing all the work and then having another agent talk to a person and say, hey, why don't you sign this so I can represent you? We're not attorneys. We're not accountants. We're not, I can get a quote for anybody on this street without their permission. I could send something to the company if I wanted to and walk into their office and say, hey, I got this quote for you. If you would like to come to us, here you go. I can do that. I wouldn't do that, but I could. There's nothing, an attorney can't represent you probably without you signing some sort of a contract or some sort of document saying, I'm allowing you to represent me. I'm an agent of the insurance company. I'm not an agent of the public. I'm an agent of an insurance company. So that's who my relationship is legally with them. But of course, I'm a salesperson and I come to visit with people and explain the situation. Now, any agent that ever shows up and says, you have to sign this in order for me to get you a quote, that is an out and out fabrication. That is not true. So, and unfortunately, I have seen that happen before where all of a sudden I get that letter in the mail that says, oh, one of your customers signed an agent of record letter for a different agent. So we're going to send the quote to them. And I go to my customer. I said, did we do something wrong? I'm sorry about what happened here. And they go, well, I didn't know that. I was just trying to get another quote. And the guy told me if I didn't sign this, he couldn't get a quote for me.
Gotcha.
Again, this is something for board members to be very conscious of. The guy goes, well, I can't. No, unless you really want to, you really want him to get that quote, then that's up to y'all. That's another thing. Everything is strictly your decision. This is y'all's business. This is y'all's association. And so you get to be the one to make those decisions. So.
And I had another question about types of coverage or company underwriters that you're just seeing. Well, we know there's some that just are saying we've done with coastal business. I have a real estate brokerage in Colorado, so we're starting to see certain carriers just, if you have the screw types of fire extinguishers that drop down and the heads haven't been replaced in the past 20 years, they don't care. They will not insure you, period. So are there any specific caveats or certain ages of certain complexes here that you just cannot see? No one will write, or
it's very
expensive.
I don't know if y'all recall a few years back when that high-rise condominium in Florida collapsed. That building was built like in 1982. It had a 40-year guarantee basically from the builder, and it collapsed at 40 years and 1 month. It was just beyond that little type. Now, this is when I go back to the continuous maintenance program, all of these people, all these hundreds of lawsuits that have been filed. Coastal high-rise buildings are extremely difficult to insure, no matter where they are. But coastal on the island, any building that's over 4 stories tall is probably going to be a very difficult, very limited marketplace.
So over 4 stories in any particular age?
I would say that 40-year period, if it hasn't had like roof updates and stuff like that, you probably don't have a shot.
Any particular construction style? I mean, most of
this stuff here that's a high rise was built what's called superior construction, or concrete walls and concrete decks in between the floors. Anything that was over a certain size or certain floors amount. So
not anything that's over 4, but anything that's under 4. Is there any particular kind of structure of components of common spaces, things like that you just see are
there was an old stucco that was used in the 80s and 90s called EIFS, EIFS, this exterior insulating finishing system, which was a stucco that was kind of a man-made type of stucco that ended up being porous and allowed moisture to penetrate the stucco and then did not allow it to exit. So this is when all of the mold crisis happened in the early 2000s and and there's a EIFS exclusion on almost every policy now. Any people that have asbestos insulation, asbestos exclusion, lead paint, lead exclusion. There are various things that were typically older properties that had a lot of that in there, that had huge lawsuits, and then every insurance company excluded it going forward. So sure. Yeah. Anything else, Sandra?
That's it.
Okay. Again, thank you guys very much for allowing me to come in and ramble on for a little bit, but I appreciate it. And if y'all need anything, again, feel free to give us a call. Thank you.
percentage increase over the next projected year?
The resource association that you were mentioning, has, there was a 10% request increase by the actuaries and the state legislature and insurance. So it is a 0% increase for the next 12 months.
Okay.
So there is no increase for which.
Okay.
The other carriers, I really didn't tell you, it seems like with inflation starting to go down, it seems like it's a little bit less.
Yes.
To expect.
Yes. And this is, their policies are January to January. Yeah, thank you so much. We are asking the same phenomenon that he does, where like suddenly your flood is due in January, but then your liability is in July, but you've done your budget in September, and it's like, what? So we created separate line items for insurance to collect it, and don't let that get tangled up in your operating expenses.
That's what a lot of people do. I don't believe in some associations that I only have one used to that 40 units and I get all the bill. If you have I would say that once we got the, it was like 3 weeks in advance and she would find something. So she would collect enough to take a down payment and then finance the remainder of the previous. And here, except she would pay it off early, so within 2 months, all the money had come in. So she'd take a small little service charge, whatever it's going to charge. So it was done in 60 days instead of. So that was kind of the way the thing handles that. Late notice or the shortest term. Probably different ways. Sure.
You put it in the HOA fee. Remember to back, but you don't say anything. It's all insurance.
Okay, if we can take a seat so we can get Kathy started. Thank you so much, Ray. Appreciate it. Kathy Cunningham is a local attorney. I'll let her do a little history on herself, but she's going to talk to us about legal assist.
Thank you.
All right, good morning. As she said, my name is Kathy Cunningham. I am a local attorney. I've been an attorney for 24 years. When I graduated law school, I stayed in San Antonio for about 12 years and worked there. And then about 12 years ago, I moved down and joined my dad's practice and practiced with him for about 4 years. And then this is a lot of what I do is a lot of condominium law. I really, really enjoy it. As well as probates and estates law, some real estate, some banking work, and corporate work. But my bulk part of my practice is condominium associations. Obviously, there's numerous ones. I have a PowerPoint that really is just going to focus, it's going to pinpoint fiduciary duties and board duties. There are many other areas and areas of law that address board duties, but I'm really focusing on the fiduciary aspect and your responsibility as a board member. How many board members do I have in here? Probably some online too, I'm assuming. So as I go through, if you guys do have questions, you may certainly raise your hand, interrupt me, happy to answer. If not, I think I've left enough time at the end for you guys to address some things. And I'm going to tag team a little bit off. Wade brought up a couple issues that I want to kind of segue because you guys had a couple of questions and I want to bring that into the board duties. And is that a breach of fiduciary duty or did you comply with your obligations? That is my email address. Fortunately, I think I forgot to bring some cards. So if you guys want to take it down, it's Kathy@CunninghamLawSPI.com. If not, I believe Sandra's got it as well. All right. So first I want to go over.
It's on the set, or I pointed to it.
There, thank you.
Good enough.
There you go. Cool. All right. I'm going to focus on Chapter 82. Chapter 82 of the Texas Property Code is known as the Texas Uniform Condominium Act. For those associations that were developed or built prior to 1994, Chapter 81 is known as the Texas Condominium Act. We have the Texas Condominium Act and the Texas Uniform Condominium Act. 82 kind of blows up the various areas and expands upon the laws to kind of aid an association. So you probably have 81 and 82 for Tiki, and then anything after 94, only Chapter 82 is applicable. Nevertheless, I think this should apply to all associations, no matter whether they were formed pre-94 or post. I think that's how a court would look at it. But definitely any association that has adopted Chapter 82 or was built after 1994, you have a statutory scheme that locks you into this fiduciary duty. All right, so fiduciary duty. Texas Property Code 82103 says, except as provided by your declaration or your bylaws or this chapter, the board shall act in all instances on behalf of the association if in the good faith judgment of the board, the action is reasonable. Key terms, good faith judgment and reasonable. Each officer or member of the board is liable as a fiduciary of the unit owners for the officers or members' acts or omissions. All acts of the association must be by and through the board unless otherwise provided by the declaration of bylaws. I've always seen acts through the board. I've never seen it where it's isolated. So, that same section goes on with F to say, an officer or director of the association is not liable to the association or any unit owner for monetary damages for an act or omission occurring in the person's capacity as an officer or director. So you got the director's hat on. If you're doing it within that scope, in accordance with the guidelines, then you shouldn't be liable unless the officer or director breached a fiduciary duty to the association or owner, officer or director received an improper benefit, or the act or omission was in bad faith, involved intentional misconduct, or was one for which liability is expressly provided in the statute. I'm going to give you guys examples, or we're going to go through some examples.
Go ahead.
Thank you. Oops. Okay. We're also going to touch on this. This is another body of law that's applicable to nonprofit associations. When you all as a condominium association are formed, it went crazy.
Yeah.
Okay. You form as a nonprofit. Texas Business Organization Code, Chapter 22 addresses nonprofits. So you've got a couple different statutes and areas of law and bodies of law that kind of come in together to apply to you. This is fairly consistent with how Chapter 82 reads, except Chapter 82 is a little more detailed. But again, a director. So you guys are a director of a nonprofit. If you're on a condominium association board, shall discharge the director's duties, including duties as a committee member, in good faith. There we go again. Ordinary care, and in a manner the director reasonably, here we go again, reasonably believes to be in the best interest of the corporation. They are not liable for an action taken or not taken as a director if the director acted in compliance with this section. A person seeking to establish liability must prove the director did not act in good faith, did not act with ordinary care, and they acted in a manner that the director reasonably believed to be was not in the best interest of the corporation. This section continues on and provides that an officer is not liable to the corporation for any action taken or omission made by the officer in the person's capacity unless the officer's conduct was not exercised as follows. Again, in good faith, with ordinary care, and in a manner that reasonably believed was in the best interest. This section shall not affect the liability of the corporation for an act or omission of the officer. So the corporation, the association could still be sued. Think about it. As a director, you could be sued personally. And let me tell you what, if somebody's angry or they felt like you breached a fiduciary duty, they're going to probably sue the association as a whole, and then they're coming after you individually. This is why you probably have directors and officers insurance. He didn't touch on that. He touched on mostly property insurance. But you definitely want D&O. Even if you're doing what's in the best faith and you feel like it's reasonable and it was based upon sound judgment, when it hits somebody's pocketbook, they're mad, they're going to find a way, right? But this should give you some reassurance that, hey, I'm falling under the umbrella of these statutes, so long as I took those steps. So how would a court look at it? And how are the decisions of a director viewed? Business judgment or reasonable standard rule, okay? So it's an affirmative defense to the actions of a director and generally is described as follows. So a director must be informed of all material information reasonably available to them before making a decision. Back to the question you were asking of Wade Sales. Hey, how do I know I'm getting the best insurance? How do I know I'm getting a competitive rate? you all as a board, or just generally the board of directors, they can't just say, oh, I'll take that first one and I'm good with that. No, you've got to dig in. You need to find out, what information am I getting? What information is available when we make our decision? This is how a court's going to look at it. Was the action or decision reasonable in light of the circumstances? Okay, everything's going to be factually driven. Did they seek a professional opinion? Should they have gotten an engineer? Should they have consulted with legal? Should they have consulted with their insurance on whatever decision is being made? Or do they just say, you know what, I've got the expertise, I'm going to do it myself? Were they informed and rational about the decision? Did the director act fairly or loyally? And was it in the best interest of the association? Or was it for a self-benefit? Hey, I'm going to do this because you know what? I'm going to sell my condo next week, so I need to make sure I get this deal because I want to make it favorable for, the buyer. Did the director avoid a conflict of interest? Again, same concept. And did the director act within the scope of their authority in accordance with, when I say CCRs, I mean your declaration, your bylaws, your rules. Those are your covenants, conditions, and restrictions. All right, acts that are not covered, and then I'm going to go through some examples and give you guys an opportunity to talk through things. Acts that are not covered. Ultra vires acts. That's basically an act that is independent, has nothing like that. Let's say the board said, we made a decision to, hire this engineer and redo the EFIS or the stucco. All right. And Kathy Cunningham was on that board, and Kathy Cunningham walks away and says, you know what? I'm not going to do what they say. I'm going to go hire a different engineer and authorize that engineer to go do this instead, or I'm going to authorize my contractor to do this. So it's an act that is not within the scope of what the board decided. Illegal acts, if you can think of those. Fraudulent acts, gross negligence, self-dealing, failing to act loyally, failing to avoid conflicts, or acting in bad faith. Let me come over here. Okay, I'm going to go through some scenarios, but first let me go back to one thing that y'all had asked of Wade Sales. He indicated that there was an endorsement with regard to increased construction costs. Let's say the scenario is presented to the board. All right, you guys look at it. You're like, your declaration, your bylaws say we just have to have a max of 80% coverage. Okay. All right. So we evaluate that. We're looking at it. And all of a sudden this endorsement covered. Sales comes in and says, guys, your 80% may not cover if you have a fire. Right? But we have this endorsement. And that endorsement would provide for these coverages, but it's going to be at a cost. As the board, would it be a breach of your fiduciary duty to not add that extra coverage? Those are the things you're going to be faced with.
Right now, excuse me, but I know our bylaws is 80%, at least 80% replaceable cost. But the real verbiage is 80% of current replaceable cost. Because within the last couple of years, skyrocketing the price of everything. And I can tell you that many condos, I assume, on this island are underinsured.
You definitely have that. So you're faced with it. So I can't give you the answer. Like I can't say, yes, that's a breach, or no, that's not a breach. It's based upon, go back to those different points.
But back in the bylaws, does it say the word current?
No, because nobody's thinking about that.
It's sort of implied.
I think that's based upon whatever information you as the board have, which is why you guys have to do what is in the best interest of the association, right? Is it reasonable? Yes, it's going to cost more, but is my professional advising me to get it, right? What do we know our age of our unit is? Is it something that we need to get? Hey, guys, if there's a fire and they have to rebuild this, are we going to be liable if we don't get this? Those are the questions that you want to ask and that you think through. And it sounds like you guys kind of already muddled through that. But, you just can't willy-nilly go, oh, no, we're not going to do it because we can't afford it, right? The board will probably be looking at a lawsuit if somebody whose unit burns and you guys, you only covered 20% of it. So, all right. Sharing confidential information. This is a scenario. An owner requests a reasonable accommodation to have a parking space near their unit. And the board, after consulting with legal, grants such a request. Keep in mind, the parking spaces are open to everybody. There's not a particular parking spot for one person. So owner comes in and says, hey, I have a disability. I need this special parking space. They consult with legal. They say, sure, we're going to grant you this parking space, even though your declarations do not allow for, assignment of parking spaces. Another owner is upset and wants a close parking space, comes to the board, which is then denied. They didn't ask for the reasonable accommodation. It was not apparent. Then demands to know why the owner that got the special parking space. They want to know, why did you give it to him? What should the board do?
Well, so that if nothing like that is mentioned in the original bylaws or member declaration, but shouldn't they have to adapt to what the Association of Disabilities, American Disability Act, they give them some help?
Sure. Okay. So what she said, for those online, she basically indicated that either something needs to be changed in the bylaws, or there's a question about whether ADA or American Disabilities Law applies. My first thing that I would tell you to do is I would say consult with your legal. Absolutely, right off the bat. Secondly, if this scenario occurred, I would advise, guys, board, you would be breaching or violating a law by discriminating against this person. It's actually under the Fair Housing Act, unless it's a complicated issue. American with Disability Act may or may not apply to your condominium association because it's public place, right? American with Disability applies to public places. But your condominium association may have transformed itself into a public place, thereby having ADA apply. Now you see why you have to consult with legal. There's a lot of things that roll in. Fair Housing Act does. And if a reasonable accommodation has been requested, there's an analysis. That example may not be true every time. I'm just giving you one scenario. But as a board, you would want to consult with legal. You also, how I would respond would be, you just let them know they made a request for a reasonable accommodation and we accommodated. Leave it at that. You can't say really anything more. All right. What about sharing board discussions from an executive session? Would that be a breach? Y'all know what I'm talking about when we're talking about an executive session? Everybody knows. So executive session, it's statutory. You're permitted only to exit. All board meetings are open to owners. The board is permitted to excuse themselves into executive session. There's a litany in Chapter 82, but basically it'd be for personnel issues, contract negotiation, litigation, on the request of an owner to keep something confidential, attorney-client privilege, or maybe one more. Those are basically the basis, right? Did I say contract negotiation? Okay. So you can exit into executive session. Let's say there's an executive session where an owner has, protested some, the board fined him for a violation, and the owner said, hey, I'm challenging you. That might be in an executive session, and you guys hold it and things are discussed. If somebody exits that executive session, you as a board member, are you permitted to go and tell everybody what happened? Okay. I mean, it seems obvious, but what if the person was your friend and you're receiving pressure? Again, those are the things that come up. It seems like, yeah, it's black and white. But what's going to happen is you're going to have, oh, that's my neighbor. And oops, I want to talk to them about what happened or not. Caution, do not. That would be a breach. Go ahead.
When a board is going into executive session, either announced or if they realize during the meeting they require it, do they have to say why they're going into executive session?
Here's my personal opinion. I'm always going to err on the side of caution. You as the board, because of your fiduciary duties, I would absolutely be open. I would absolutely now. I wouldn't necessarily go into the details of it, but I would cite to whatever provision in the statute, the basis for which you're going into. Contract negotiation. If it was, let's say, something was brought up about a violation history of an owner. Board, keep your mouth shut. All you could say is I'm going in because the owner requested, privacy. My recommendation would be, if you're going to go into it, you indicate what it is you're going in for. And then you have your executive session. If you need to come out and say, the action was this, I would limit it to that. Again, every scenario is different. And I apologize, what she asked earlier, so that everybody online knows, she asked, does she have to announce whether the subject matter of why she is going or the board is going into executive session? So I think that answered your question. Again, if you guys ever have a question, just shoot an email. I mean,
are you able to receive feedback or I should say input from the rest of the membership? Because they probably, if it's a hot topic enough that you're going to executive session, they probably know what it is. If it's a small complex, right? Quite often.
okay.
Are you able to ask for feedback and take that into executive session or input, or does it have to be completely separate from the meeting?
Okay, so the question was before a board exit or enters into executive session, if it's a hot button issue, can the board accept, comments or information from owners? That's really a board issue. You guys can. I would just caution normally what I will tell boards. I'll say, look, you guys, if it's a board meeting, the board controls the room. That no owner has a right to speak because you guys have been delegated the duty and appointed and elected to carry on the business of the association. I have boards where they'll say, look, we're going to have a board meeting. Any owners present, I'm going to give you 1 or 2 minutes to if you have like public comment, and then boom, you guys go into session. If it isn't a hot button issue, you can also just have a general board, a general open meeting with the owners and say, hey guys, this is a topic that we need to discuss, and then get your input, but then on a separate date, have your board meeting.
Okay.
But so to answer your question, yes, I think you had a question.
I had a question. Would that be if you're announcing the topic for executive session, will that topic be included in minutes?
Yes, and you could probably seal those minutes. You're going to have some, and again, not everything is accessible by owners. That's a whole nother session of producing information. Again, I would say consult with legal at the time because it depends on what you're talking about.
Right now. Should I add it?
Just like Wade said, every scenario is different. I'm giving you generalizations. So
Right.
no, I'm not going to answer that question right here because one day the answer might be yes, and another day might be absolutely no. So it depends on the circumstances. Generally speaking, you'll have minutes. I would suggest that depending on the scenario, you consult with your legal if you have a question about it.
Well,
I'm not
it's
trying to-
that big of a deal.
Yeah.
It's just.
It depends.
To be included.
Yeah.
Well, that's the biggest word in American, depends.
So let me give you a reason why I say it that way. I had a board one time come in and one member came in, and this is why I always say, I just want one point person from a board. I had a board come in. One person came in and asked me the question and described the red car and said, give me your opinion. Another one came in and said, describe the maroon car. I gave 2 different opinions because I got a different factual scenario. So that's why I say I can give you the answer.
Right now.
Yeah.
I got it.
Cool.
I have a question.
Yes.
You mentioned that the complex might not be liable for giving the disabled person access to the apartment. When, and that it might have, if it becomes public, when does it become public?
The question was, she wanted to know, you're talking
When
about,
does the complex become a public place? But you said the ADA.
it's again, she just asked, when does a condominium complex become public? There are factors. It could be that, have you allowed the public in? Have you allowed like this tiki room? Have you allowed non-association members in here to use it? And are you charging people to use it? That's a factor. Do I have a lot of rentals? Do we provide a front management service for the rentals, right? At that point, yeah, you're beginning to transform yourself into a public accommodation whereby the ADA applies. Okay. Awarding a contract to a family member, you as the board, you're trying to decide, hey, we need to do some pool maintenance and we need someone reliable. We've got a lot of pools here, for example. So board member's family has a pool business and has submitted a bid to the association to maintain the swimming pool. And the contract's going to be for, let's say, a 2-year contract. What should the board do?
I'd like to see some other bids.
Absolutely. So he said, I should see some other bids. Any other thoughts?
There's a conflict of interest, right?
Okay, so what should that board member do if that comes up? Let's say we've got 3 or 4 bids.
Give them the more bids
Recuse
and
themselves.
abstain from the vote.
There you go. So you get more bids, you investigate a little bit further. And the other comment was abstain from the vote. So yeah, step out, just say, hey guys, I'm not going to vote on this. I'm going to keep my mouth shut and allow the other board members to do that. I think I might. All right.
Come on, Chief.
Got it. Okay. All right. Failing to maintain the common elements. It's interesting that we brought up the Florida case. All right. Wade had it from the perspective of insurance. I'm going to give you from this perspective. And this was the example I put in. I didn't talk to Wade at all, but it's definitely in my mind. Past boards have not invested in the exterior structure of buildings, and the disrepair and degradation is becoming apparent and unsafe. The board hires an engineer to evaluate the structures and provide a professional opinion. and the necessary steps to repair and restore the building. The board learns that the cost to conduct the repair is over $2 million. Would temporary repairs be sufficient? What should the board do? Is the board breaching its fiduciary duties by postponing the repairs?
Send out a special assessment now.
So let me briefly touch on the Florida case. That Florida case, what happened was, in addition to the building being super old, they had an underground garage, or the first floors were the garage. The surf kept going in, and basically the entire structure, the foundation, was getting degraded. And several boards kept passing this up because they didn't want to impose a special assessment. They had several engineers come out and advise them, you need to get this fixed. Your rebar is showing. This influx of salt water is degrading the actual foundation. I think they went through a couple engineers, several boards, and nobody wanted to take it on. They kept ignoring it, pushing it down the road because the assessment was huge. You bet they got sued. And you bet each one of them was sued personally.
The previous board members, even when they were off.
Anybody who was involved in that and did not take any action. So, yes.
I just have a question, because this has come up in other, conversations I've had with boards. What if in the annual meeting, when the budget is presented and the reserve study or reserve analysis or whatever it is that's discussed that determines, what should our special assessment be, if any, or the reserve contribution, and they say, we just don't have the money to do this, and present that to the owners, and the owners agree with that, that assessment, however low or high it is, does that protect the board?
So the question was if the board determines, hey, our reserve study either doesn't tell us to do this or it costs too much, so the board then turns around and presents that to the homeowners for a vote. Hey, homeowners, do you want to pass this special assessment of X amount to repair the building? Okay, so does that protect the board? It's hard to say, right? Now, what I can tell you is in those scenarios, I do, if I say a board's uncomfortable, I say, well, give it to the homeowners. Or first off, I'd probably advise board, you need to pass this. And if you think it's going to be bad for the members, present it to the ownership too, but you guys are still the ones stuck with the obligation. So I can't say it completely shields you as a board. You're still going to be liable because the board is the fiduciary that either made the decision or didn't make the decision. I will also say this. Let's say there's one homeowner out there, Kathy Cunningham, who voted for it. I wanted it. I'm absolutely suing you. And I'm absolutely coming after each board member. And you'll absolutely be liable. So I can't say you're fully shielded. I can't say the board will be shielded. I would say consult with legal at that time. If all of a sudden nobody wants to do it, I would write a big letter that says, you need to do this, guys. This is what's been advised by your insurance. This is the history. This is what the end result is. You know what? You got to do it. You got to do it.
How much does the D&O insurance really protect you as a board member?
How much does D&O insurance protect you? It affords you those protections with whatever the insurance policy reads, right? So if you're not covered under some of those acts that I mentioned, fraud, breach, things of that. It's whatever you guys purchase in your policy, whatever endorsements are purchased. So yes, I advise all associations to get DNO, but take a look at it, see what you got, talk to your agent about it. Say, hey, these are some concerns, Wade or whoever your agent is. Can you talk me through this? Because every policy is going to be different, right? So, but my advice, get it.
But historically, have you seen them come to the aid of the
Yes.
lone dissenting board member who said, the sky is really falling?
The DNO, the question was, have you seen DNO actually, come into play when it's been purchased? Absolutely. All right. Failing to enforce your covenants or restrictions, your declarations and your bylaws. So an owner that often has conflict, let's just call it a problem owner, the one that the board is tired of dealing with. We don't want to hear from you again, right? Places a towel over the balcony railing in violation of a rule. The board in turn notifies her of the violation and warns her that she will be fined if she has not removed the towel and the behavior needs to be stopped. She hangs the towel again the next day and she was fined. In turn, she takes pictures of all the towels and bathing suits hanging from other balconies and notifies the board. What should the board do?
Find them all.
Enforce the regulation.
Right? So someone said find them all, another one said enforce the regulations. Has the board breached their duties by only targeting that one owner versus the other? Okay. All right, so that everybody's nodding their head yes. So that's kind of an obvious one. But trust me, all these scenarios I'm giving you have happened. Every single one of them. And you're like, Kathy, it seems kind of black and white. When you're in the mix and you're working through stuff, things become gray.
So I got one question here, I've seen this under rules. I don't know if it's under bylaws, but I have a dumb question. Is the difference between declaration and bylaws? Because you've been using it interchangeably.
No, fair enough. The question was, and I apologize if I wasn't clear on that. The question was the difference between rules, declaration, bylaws, because I've kind of used them interchangeably. When I reference CCRs, covenants, conditions, restrictions, or if I say dedicatory instruments, that's from the statute, that is referencing your declaration. Your declaration is the document that dedicated the condominium regime to Chapter 82 or Chapter 81 to make it a condominium, right? That's just kind of the general, and it will have restrictions in it. It has to be a residential complex. It's got to be a condominium. You're going to be assessed, things like that. Bylaws are really the document that govern how the board operates, how you hold meetings, how you hold owner meetings. And it also may have other restrictions in there too. It may have, a set of rules in there.
And the bylaws, I'm sorry, but so as far as bylaws, if you would want to change a bylaw, I guess the owners are supposed to take care of their own windows.
Okay.
Versus the HOA.
Okay.
And it's sort of a big deal.
Okay.
So we make that, you have to have usually 66% of owners to change the bylaw in a vote is or 67%. And then you have to go down to the courthouse and file for an amendment.
Okay.
Yes, on a bylaw.
Okay, so his question was to amend or change a bylaw, and notify me, guys, if I need to wrap things up, just FYI. The question was, what does it take to either amend a declaration or a bylaw? And then once it is properly amended, do you have to go down to the courthouse and report it? So let me go back to the beginning. Every set of bylaws is different. Declarations are different as well. So some declarations are typically harder to amend. They typically will require a higher percentage at 67 or more. I've seen 75%, I've seen 100%. Bylaws tend to be a little bit easier. They have a lower standard typically, but they may not. They may track exactly what the declaration says. So whatever your bylaws say, or whatever depending on which document you're looking to amend, you have to know what the requirement is. Once it is properly submitted, then yes, recent laws from 2012, I believe, requires that anytime you amend any dedicatory instrument, bylaws, decks, including rules, amendments, it must be recorded in the public records. That way all owners can get access to it.
What public records? Not,
Cameron County, the record,
you're talking about going into the courthouse?
yeah,
Okay.
and it,
Even a rule?
Yes.
You got just normal rules?
If you're
Out
going-
of the pool, you've got 16 rules, and I want to make 17. And I gotta go to the courthouse for those rules?
so the question was, if we amend the rules, the pool rules, whatever the rules are, do I have to, record them? When I say record them, that means they have to be recorded in the Cameron County Public Records or wherever your project is located. I can do it. I do it electronically all the time for clients. Yes, if you fail to record whatever you seek to enforce, it is not enforceable.
Interesting.
So, yes, sir.
Okay, I have a question in the online attending. It says in the scenario you talked about, does a vote of the ownership count for anything since the board is entrusted to make decisions on assessment?
Okay, so the question was, ask it again.
It says in the scenario you talked about, does a vote of the ownership count for anything since the board is entrusted to make decisions on assessment?
Okay, so the ownership, yeah, sure. I mean, it's worth considering what the ownership does, but the question becomes, is it a breach of the board's duties if they fail to take the action? The reason the board is appointed and elected to for the association is so they can run it, right? If all of a sudden you've got a bunch of owners who are like, I don't want to do anything, I want to fix up that condominium. Well, sorry, board, you're tasked with those duties. But by the same token, I think it's smart if it's a hot button issue, I conservatively say, hey, involve ownership, but board, if it's your decision, it falls on you. But again, every scenario is different. I'm giving you guys some generalizations. Back to that assessment, I think Wade Sales had mentioned something about if you're having to do a special assessment on insurance, can the board do it? My caution is this, I don't know what your documents read. I don't know if your bylaws and your declaration allow the board to impose a special assessment, or does that require homeowner approval? I don't know. So to the individual online, it's a hard question for me to answer because things can be different factors can come in. But there's some declarations and bylaws that I see. The board is authorized to impose a special assessment not to exceed, whatever, $3,000 per unit. Well, if you have to do a special assessment that, I don't know, is $1 million, you're going to have to go get the homeowner approval. And normally I'll help boards work through that. I'll say, look, there's options. You guys can go borrow. You have to do it, right? You have to do it. You can't say no. So I'll create options and different ways to kind of maneuver through that. Let's see. Okay. Let me see.
Off the top of your head, would you know the statute that you just referred to that requires even the rules to be recorded? Because that's fascinating.
It's Texas Property Code, Chapter 202, but I don't remember the exact section. It basically says any dedicatory instrument must be recorded to be enforceable. And dedicatory instrument is defined as generally as follows: your declaration, your bylaws, your rules, any amendments thereto. It also includes other things, but that's the gist of it.
Because a lot of associations change them willy-nilly and they are not
Correct.
recording them. That's
Correct.
fascinating.
Correct.
Okay.
A lot of people either don't know, and that's not, it's just maybe they haven't either consulted or they're like, you know what, let's just do it. That's fine. If you're enforcing it, you're enforcing it. But if it hasn't been challenged, okay. But yes, to have it be enforceable, it needs to be recorded.
Thank you.
And here's why. If I'm an owner and the board passed a rule, if they were authorized to pass it, right? And I go and I violate that rule, but I didn't know about it. How can you find me? But you can't plead ignorance if you recorded in the public record. Sorry, owner, it's recorded. Here it is. So, any other questions?
Are you leaving or are you staying here?
I'm probably exiting.
So I'm going to catch you at the exit because I got two more questions.
You got it. You got it. Anybody else?
Sorry. One more. There's the state HOA recording requirement that I see where they have to be registered with the state and the county as an HOA management.
You're talking the management certificate?
Yes. And it has listed the president. I see some associations do that, some do not.
There are a lot of legal requirements that some associations do and some do not.
So how
Numerous.
numerous is that to have that done? I mean, are there penalties? And then I've heard with the Corporate Transparency Act, now we don't have to file
Here's what I recommend.
information on the LLCs that changed like this week.
Okay, those are loaded questions that require a much more extensive response, but basically she asked if you're required to file management certificates. Yes. And then she asked about the beneficial ownership information, which is a new law that requires you to basically register with the federal government. My opinion is that condominium associations should do it. I haven't relooked at it, but that is my opinion that you have the board of directors should be the one, if not the manager.
Thank you.
What's the difference between the board of directors and the council of owners?
Council of Owners, the question was, what's the difference between the board of directors and the council of owners? The board of directors is the board or the council of owners. The council of owners would be the owners, the ownership. If you have 144 owners and you have a board of 7 people, the board is the 7, the board of directors, and the council of owners, everybody.
Okay, and the rules, if you want to change the rules and take it to the courthouse, do they have to be pre-approved by the owners?
She questioned, did the rules have to be pre-approved by the owners? I have no idea what your documents state, so I cannot answer that. I don't know if it requires ownership or board approval. I don't. Everything is factually driven based upon your documents. All right, thanks guys for everybody online too.
Thank you. Yes.
Yes.
Yeah.
Okay. Yes, not the board. Yes.
Well, I mean, it's pretty wide. It just. Like, just like it's true. Okay.
Yeah, just.
And I have it right in front of me, so people see instead of seeing the profile on it.
Nice to meet you. Sorry for.
No, I thought you were the attorney.
You're okay?
Yeah, I think I'm okay.
Sorry.
Just my, give people a minute.
Right.
So.
Thanks for including that. Very important. And I want to be an attorney. But it's very important. Yeah. So now have knowledge. All right. Did that gentleman have questions for me or he?
Danny,
He actually did.
he's right there, he's catching you.
I was like, that's exit.
He's a runner, even if you would have gotten down, he'd have caught you.
It's right. I'm so extroverted. White. Right. And I've been in really for 25 years. So I understand. It's not, ski towns or beach showers, exactly the same. Part of it with the residents.
The labor day. So that was it.
And I've been part of. They would change this place more. Because you have people that were my best themselves understands coming here and having some sort of an expectation. And I'm not talking most people that best here any once it got quickly, super like, wow, I thought that was good. The ones that are sweet, I just have a certain very expectation.
Oh, so I was kind of halfway there. They was their neighborhood. Sure. And I was like, why that's another cohort. These four guys, they're all guys. They get a ride sometimes. They don't explode the ride. Oh, yeah. Yeah, he's the guy you want.
Very good, everybody. Hey, let's go ahead and get started. I know the muffins and the tacos are awesome. It's been great, and we've had some great presentations so far. It's kind of hard to follow, you know, the insurance guy and the attorney. So anyway, we are going to talk a little bit about HOA finances, and there's a lot of stuff that I have on these slides that really we're not going to be able to. If I do this, go and move it.
You got to point it over here, John.
I pointed over that way.
Yeah, the pointer's on this side.
Ah, gotcha. Okay. So what we'd like to cover here is we want to make sure that I understand the audience is mostly board members. And if we had some property management managers here, we might delve a little deeper into some of these things. But as board members, what are some things you want to, we're going to highlight some of the things you want to consider as you're looking at your internal financial reports. What are some things you're looking for, right? So we're going to look at how to read your financials. Do you have to have an audit? Is that really required? What's the benefit of having an audit? And what other opportunities or services that, you know, your CPA professional can provide you that is not an audit? How do you manage your reserves? How do you know how much you should have in reserves for, you know, the future major repairs and replacements that you're going to have to incur? We're going to talk a little bit about budgeting, and then the new beneficial ownership information requirement, which, if you've been paying attention, U.S. District Court of Texas, I believe, the judge just came out and said, we're going to put a hold on this for now. And so we're kind of appealing it. So we're not sure what's going to end up happening. And what we're telling our clients is, if you haven't done it yet, don't sweat it. If you have done it, you know, give yourself a big bright check mark and you're going to be okay.
So it's okay to hold off if they haven't done it yet.
If they haven't done it yet.
What is it?
What's that?
What is it?
Oh, we're going to talk about that.
What is it? Okay.
It's the
Now tell us.
uniform, what do you call that? What's the actual name of it? The Uniform
Beneficial
Ownership
Corporate Transparency Act.
Public Transparency Act. I have a slide at the end. We're going to go through what they're asking for, but I'm going to kind of preempt that by saying right now, it may not be as big a deal to you right now if you haven't done it. Whereas it was, we were calling our HOAs and saying, hey, you better prepare for this. You got to have this done. So, all right. So when you're looking at your financial statements, I don't know if you have, if your books are kept in QuickBooks, or if you're using a property management software like Yardi or or some of these other, softwares that will account for everything on a fund basis, but they're basically two different ways you can present your financials with an HOA. There's what's called the fund approach, and there's also the non-fund approach, which is just a single column. But it's important that if you use the non-fund approach, you make sure that your reserves and your operating funds in the equity section adequately and properly account for the reserve fund items and the operating fund items. Got to make sure that's very clear in your financial statements. A lot of the HOAs that I've worked with, a lot of them do use QuickBooks, especially the self-managed HOAs, where they just have one manager on site. And that's totally fine. Just make sure you track the dollars and the everything per fund, so you're not losing track of that. Accrual versus cash basis. A lot of management companies like to maintain everything on a modified cash basis because they don't want to track the receivables and the payables. Best practice is full GAAP, full accrual, because it makes it a little easier to really see what your receivables are, who is paying their receivables, who's delinquent, and you can really manage that better if you're accounting for everything on a full accrual basis. So here's just a sample of what a fund basis balance sheet looks like for an HOA. If you haven't seen this, this is kind of what it looks like. You can have more than one fund. I mean, this is very basic. You got your operating fund and your reserve fund. I've had HOAs that have an additional capital projects fund, or whatever the HOA is budgeting for to track. You as a board basically decide what that is. But most will have a reserve fund and an operating fund that needs to be tracked. And you can see how this presentation shows the borrowings between the two funds and the taxes and in the case of the income statement, the income, the inflows and the outflows on an accrual basis. So you can see it a little more clear than if you're just looking at a single column presentation. Statement of cash flows. I don't know how many of you use that at all, but if you have an audit or a review that's a GAAP basis financial statement, this is going to be one of the required financial statements that's going to be included. Also, if you have a GAAP basis presentation, there's what's called required supplementary information that needs to be included in your financial reports. Basically, it summarizes future major repairs and replacement expenditures. It will, at a high level, identify the components that are being reserved for, the estimated remaining useful lives, the estimated future replacement costs, the funding requirement. This is the amount that would tie right back to your reserve fund equity, which would be, in this case, 39,000. Well, I meant, no, that would be the third column. The 351,000 would be the component of fund balance, but the 2,000, these years are off. I've had this presentation since 2008, so it's been there for a while. But that 2008 funding requirement would be next year's budget. Here's what we're budgeting next year for these components. Most of this information would come from a reserve study or a reserve analysis, which we're going to talk about here shortly. I just want to touch on one thing, and I don't want to spend a lot of time on this because it probably will bore you to death, but if you do have an audit or if you do present financial statements that are on a GAAP basis, there was a new accounting standard that came out a couple of years ago that requires all organizations to change the method of accounting for revenue recognition. And there was a committee, a subcommittee of the AICPA that got together and decided, okay, how should we do this for HOAs? And unfortunately, this little subcommittee didn't bother to ask anybody in the industry, how does this apply? How would this apply to our industry? And it's created a lot of problems within the industry. There's a lot of variance in practice. There's no authoritative, when I say authoritative, requirement or guidance on following this standard. But a lot of practitioners and some of the accounting guidance that is out there that's non-authoritative is recommending, following this guidance, which basically in a nutshell says, if you have reserve funds, that revenue is to be deferred until you actually spend it. And that reserve fund balance is no longer equity. You need to show it as a liability, as a contract liability. Well, that just kind of messes up the whole concept of what we're about here in the HOA industry. It's like trying to fit a square peg into a round hole. So just to kind of summarize a little bit what is happening, how this affects HOAs. CPAs are now being required to interpret how these new principles are to be applied. And the problem is that to apply this, it assumes that you as an HOA is a single reporting entity and that you have one single customer, a vendor, for example, which isn't the case. The customers are essentially all the owners. So it doesn't really fit into the same box as your traditional for-profit business.
Can I ask a question?
Yeah, I'll back up.
Oh, I'm sorry, you have one more to go.
I've got a few more to go here. So the result is, I've already talked about the assessment. Operating assessments continue to be accounted for as they always have been. It's the reserve assessments that change. So all reserve assessments are recorded as deferred revenue. Anyway, so that's kind of how it goes. Now, if you choose to not comply with ASC 606 and you're having an audit performed, we recommend this footnote be inserted that basically says assessment revenue is recognized when assessments are due. Any amounts received in advance of the due date are deferred until due. The Financial Accounting Standards Board issued accounting standards code ASC 606 requiring the deferral of the recognition of income until services are rendered. The association has determined ASC 606 does not apply to the association as no customer relationship exists as it is defined by the code. The association does not defer the recognition of any portion of revenue as a contract liability. Now, we have some HOAs that have implemented 606. We have some that have not. And from my perspective as an auditor, I'm good with either. I'm not going to say, well, if you're not following ASC 606, you need to restate all your financial statements and book it. I'm not doing that because there is no authoritative, conclusive guidance or requirement that HOAs need to follow that standard. So you can either comply with ASC 606, you can not comply and just add this paragraph in your footnotes, or you could be even easier, just report on a modified cash basis, which isn't GAAP, and you don't have to worry about ASC 606 at all. Anyway, I wanted to get that out there. I probably spent too much time on it already, but
That's good to know.
that is, and if you want more information on the logic, I've done a lot of research on this, and so I've got a lot more information I can share if you want it. All right. So as a board member, here's some things to look for in your financials as you're reviewing them. You want to look for steadily decreasing cash. What does that imply? It implies that, you're spending too much, or maybe you're not collecting enough. Significant unexplained budget variances. You want to make sure that you're watching for those as well. And if you're, as a board, if you're getting a budget variance analysis report, it'll be easy for you to identify those things. Increasing assessment receivables. These can be a problem. You want to make sure you follow up on those routinely. There are attorneys out there that will go out and collect these for you, and they won't charge the owners, or they won't charge the HOA. They'll charge the owners. So the HOA isn't going to be incurring a lot of legal costs. And so if you have problems with collections, my recommendation would be to get a good HOA attorney who can handle that. Large legal expenditures, absence of a reserve study, unresolved bank reconciliation differences. You know, we had an association that had an employee that was receiving it was internally managed, was receiving the member assessments in cash at the front desk. The owners would just come in and pay. And she got a bright idea. She started to pocket the cash, and the checks she would apply to the owner's accounts, you know, and she would just kind of roll it, kind of a lapping scheme, right? Well, this went on for about 3 or 4 months, and she was able to keep the lapping scheme going for a while until it was time for the audit. We came in and we identified some stale dated deposits that were spanning, you know, 6 to 8 months that were taking to clear the bank. At the end of the day, we found that she had stolen about $50,000 in that short period of time, all because, you know, nobody was watching the cash. They weren't looking at these.
How much was that audit?
How much was our audit? Well, we did bill extra for the time we had to spend investigating it, because we had to, you know, go down some rabbit holes. That audit was probably, this is a number of years ago, 20 grand. So yeah, it was expensive. Use of reserve fund for operations. Sometimes if you're cash strapped, owners or associations are tempted to pull money out of reserves to cover operating expenses. It's a big no-no. If you do it, pay it back ASAP so that you don't get slapped with some taxes, because it could create taxable income. Also,
Wait, can you go back to that? Because what I've seen is very commonplace is, oh, sure, we put 10% of our budget into reserves if we have it left at the end of the month. And getting them to put that in the piggy bank at the beginning of the month is very difficult.
and so you've probably got a huge liability payable to the reserve fund and a huge receivable from the other. Well, if you're filing, and Sandra can probably explain this better than me, but if you're filing under Code Section 528, I don't think you're going to have too much of an issue, probably, at least in the short term. But if you're filing under Code Section 277, which is as a corporation, that taints your reserves. It could create a problem for you tax-wise, which would make your reserve funds become taxable. And I don't know how you're filing your taxes right now, but that's something to consider.
Do board members have the right to demand to see their association's tax returns?
It's a legal question. I don't know.
Oh, Kathy, where are you?
Where is Kathy? I don't know. I don't know as a tax return. I mean, you're not a 501c. I mean, you are. I don't know. I don't know. I don't know if they're open for public inspection.
So I had a previous association experience where that association manager used all our accounts receivable. She actually referred to that as a reserve fund. And she, even when she filled out the Fannie and Freddie Mae forms for lending, she stated that amount in that Freddie and Fannie form as our reserve amount. So then when the new owners came in, I mean, it was 100% fraud. But that's why I got rid of that association manager. But it looked good on paper, but it was an accounts receivable, not a reserve fund. And now the association, we've gotten to a really great place with reserves, but it's being eaten up almost every month by non-budgeted or under-budgeted operating expenses. So there'll be quite a few months where they don't put anything in.
Mhm.
And I said, that should be our first kitty to pay to. And then we have to assess for everything else or reassess our budget.
Increase the HOAs.
Am I too militant about that? Because I'm a treasurer.
No, you're right. Absolutely.
Say that again with that camera, please.
Am I in the- Yeah. Let's see, 7 signs of fraud. We're going to talk about this real quick. Checks received that are made out to individuals, or checks received that are made out to individuals, not the HOA. HOA checks made out to the association's members or to cash, watch for those things. New vendors or large unusual increases for current vendors. I would assume everybody's, your HOA is putting everything out for public, not public, but trying to get competitive bids on your major projects when you have them. That's a good policy to have. Fees paid to unqualified service providers or related parties. Large decreases in revenue, inadequate supporting documentation for HOA expenses. And we talked about this earlier, large or unresolved bank reconciliation differences. All right, now Danny came to me before this started and said, do we have a way to get out of having this audit because it's too expensive? There are a lot of options out there. And here are just a few. You can have the audit, you can have something less than an audit. We call this an accounting review, fall between a compilation and an audit. We've often referred to this as a really crappy audit, or you can call it a really good compilation. Basically, it involves more analytics and inquiries. Then you have your statement, financial statement compilation. This is where you have assurance. This is, negative assurance or limited assurance. There's no assurance on this. An agreed upon procedure, is considered to be, no assurance provided. However, it's more targeted for what you're looking for. So if you're a board and you're saying, let's say you're a new board and you're taking over the records, you're not happy with the management company, you fired them, and you're like, we got to have an audit, right? CC&Rs don't require it, but we got to have an audit. Sometimes I get a phone call and they ask, so how much do you charge for an audit? If I ask a few questions, I find out what they really want is something more like an accounting review or an agreed upon procedure, which is specific things, specific items you're wanting us to look for. So let's say you're concerned about cash. Is the cash being spent properly? Or it could be, maybe we have a credit card and the property manager uses a credit card and we don't know if they're spending the money for themselves or if they're spending it for HOA stuff. We need to get somebody in there to investigate it. Well, that wouldn't necessarily fall under a financial statement audit because in our world, if an audit is an audit in accordance with generally accepted auditing standards, which includes a whole bunch of things that we've got to do in terms of documentation and everything that really isn't going to translate into value for the client. So we, with this engagement, the agreed upon procedure, we can kind of fine tune or tailor it to the specific needs of the client or the board who wants to target and really take laser focus at this particular issue that they're concerned about. And it's a lot cheaper, it's more efficient, and probably gives you better assurance actually in the long run. Yes.
Hey, John, there's a question online. What is the cost differences between each of the audit options? From 1 to 4?
It depends on the size of the association, and it depends on how good the books are. So let me put it in general terms. An audit is generally double the price of a review, and a review is generally double the price of a compilation. So let's say you have an audit done and it's $15,000. You can expect the review is going to be around $7,500. And a compilation, full disclosure compilation, with all the footnotes and full accrual gap is going to be around, 3,500 generally. But again, it depends how large the association is, how many amenities they have, the complexities with, what they have going on. We have HOAs in Utah that are ski in, ski out communities, and they own machinery and equipment, these huge unimogs that plow, the snow, and they got a lot more going on than your basic little 144 unit basic HOA. So it really depends. So to give an exact quote on fees, I couldn't do that. We have some HOAs that are quite a bit more than the 15,000. We've got others that are actually less. So it just depends on the size. So,
Sorry. Every time they ask a question, I gotta move it.
okay. Oh, so you're the one that moves it. I'm not the, okay. This is like a child's play. Go ahead.
I have heard that the state of Texas, a couple of years past, has now created a new standard for HOAs to be audited every year. And so I have a client who has in their bylaws written that their audit is going to be every 5 years. So their concern is that because the state law has changed now for HOAs, that they need to do it every year, which should probably supersede their bylaws. Have you heard of that situation?
No, I do know that more and more states are requiring audits. I know Nevada does, California, Oregon. I wasn't aware that Texas required audits. I know Florida does, Hawaii. That's interesting about Texas. My recommendation would be, if you're required to have an audit, have it every year, because even if you skip a year, the years that we have to do the audits, we have to audit the beginning balances, which is basically auditing the prior year. So might as well just get the product every year. But if in fact there isn't an audit requirement, my recommendation would be, if your CC&Rs require it, try to get that amended. We don't recommend it unless you really want it and you don't have a lot of trust in your management company. Maybe it's a good thing. But
What was the CCR again?
the CC&Rs, covenants, conditions, and restrictions. They're your governing part, big part of your governing documents. The declaration is sometimes
Get
referred
those changed because it's saying an annual audit.
Yeah.
What would it be changed to? What would be the?
Well, you could have them say an external accounting review by a professional CPA or something like that. You wouldn't have to say, whenever you say audit.
That's scary.
In our world, it's one thing. It's that financial statement audit. And we have a hard time navigating around that, if that's what it says. But if you can open it up a little bit. Now, you can't do that if you're in Nevada. You can't do that if you're in California or Oregon or some of these other places that require an audit. You're stuck. But if there's no legislative requirement, I get that either taken out of there or softened somewhat.
Our bylaws that all good and records shall be kept in accordance with good accounting procedures and again, audited at least once a year by an auditor outside of the organization.
Yeah, that's an audit. Every year. Yes.
John, is there a difference between condo associations and homeowners associations as far as audit requirements?
So the question is there a difference in the audit requirements as it relates to condo associations versus HOA associations or what we call PUDs? No, the gap is the same. And the audit requirement is the same. There's no difference. The accounting might be a little bit different in terms of more different amenities and, the reserve side of things, but all follows the same standards.
Just going on, backtrack a little bit. Going back to, we understand that the reserve funds should only be held for, operational expenses. But would repairs that are minor repairs that are not regular maintenance, could that be acceptable to be used
For reserves,
from reserves?
here's what I recommend. As a board, you have the responsibility for the budget, okay? If the board reserves certain assessments to be used for certain major repairs and replacement expenditures, that needs to be in your minutes. That needs to be documented. We're going to be using this money for this. We're going to be using this money this year for this. And it needs to be for those future major repair and replacement expenditures. As long as you have that documented in minutes, you should. Now, let's say after you pass you passed your budget, you're getting into it and you're short on cash in your operating fund, but you got some minor stuff like landscaping, all that kind of stuff. Landscaping isn't a reserve item. Maybe you need to rework your budget in your operating fund to square that out. But I would never recommend you pull money out of reserves to cover those expenses, because once you start doing that, it's going to be a vicious cycle down. It's going to be hard to get that money back in. And then, like Kathy was saying, if you're not maintaining your reserves and maintaining the property the way you should, you could be opening yourself up for some legal problems. Did that answer your question?
Yes, thank you.
Okay. I was going to talk a little bit about reserves. I'm not going to spend a lot of time on what goes into an audit. I mean, this is all the stuff that goes into it. If you have questions specifically about an audit, Israel back there, he's in the Brownsville office quite a bit now. He's our auditor, one of our auditors out of our San Antonio office, but he's definitely somebody you'd want to talk to, who could give you, some good direction on what to do, on what goes into one. Review, like I mentioned, that compilation, we already talked about the agreed upon procedure. Here's what an agreed upon procedure would look like. We would list the procedure. Okay, so for example, let's say you want us to look at comparing disbursements drawn on the bank account in the month of December to the signed, canceled check and related invoice supporting expenditure. Well, we'll perform that procedure and then we'll report on, here's what we found. We found 12 disbursements we observed did not contain approved signatures, nor were there supporting invoices to validate those expenditures. Well, now you as a board can take some action, decide, okay, what do we want to do about this? Now you have the information. This is something that typically, well, it might come out in an audit in the form of a material weakness or significant deficiency, a separate letter, or in our communications with those charged with governance. But you have to go through all the other stuff in an audit to get to this. Whereas, boom, it's targeted. We got the procedures, we answer them, we report on them. Did that answer your question before, Danny, when we talked about this?
I think so.
Okay, because there are other things we can do as well. I've been asked, in fact, I have a client right now that it's a Boise HOA up in Boise, Idaho. And they just send me their financials every month and say, would you look these over and see if there's anything that looks weird? So I'll go through the financials, I'll look at the cash, I'll look at the receivables, and I'll request the backup and just make sure that they've recorded everything right. Basically an accounting review. I do that every month. I give them suggestions. Here's what you can do to improve this, better account for this or that. And I kind of give them a little bit of an analysis on, it looks like you're coming under budget on these items, you're over budget on these. Here's what I recommend. I do some of that as well. It's just basic consulting.
So if we get the bylaws changed to agreed upon procedure instead of an audit annually, and we happen to have as our treasurer a CPA auditor, could he be doing it?
No, because you have
It's
to
gotta
be
be
independent.
outside.
It requires independence.
Okay.
For those,
Well, he wouldn't want to do it.
yeah, well, if he was a CPA, he would know he couldn't do it
Right,
because he's not independent. You have to be independent.
Gotta be independent.
Well, you have to be independent to perform an audit, a review, and an agreed upon procedure. You don't necessarily to prepare a compilation, but you've got to state in your compilation report that you're not independent. But you don't have to be independent. You know, if you have a CPA that's on the board who just kind of outside, just kind of provides some consulting. But then that's a board issue. You got to decide if you got some issues with, well, I don't know.
We don't have any issues with anything, except for the bylaw saying it needs to be it's required for an annual audit, which is totally ridiculous when you're using your QuickBooks.
The bylaws.
You're giving out maybe 8 or 9 checks on a 48 unit complex.
Exactly.
Every month you're getting 8 checks and they're all constant. I mean, come on.
Do your bylaws require, or does your
Bylaws
HOA
state it.
or do your CCNRs require it?
The bylaws.
The bylaws. Okay. I'm not an attorney, but those might be easier to change than CCNRs, if I understand correctly.
CCRs are tough.
Yeah, you've got the whole.
Well, that's why they gotta, in this case, you gotta still get, in an annual meeting, you gotta get 67%. And you've got a lot of lethargic people living around that probably wouldn't understand. So it's not easy to be changing bylaws.
Have you ever had an audit?
Not in my time.
Maybe if you had one, you could prove to membership that it
Maybe they
wasn't
don't
necessary.
spend the money on.
But you'd be surprised how you can cook the books on a 48 unit complex. I've seen it. You can run parallel accounts like crazy. You wouldn't even know it.
I hate to
Maybe we got one and then you can convince your membership.
Go ahead, John.
That you
I was
don't,
answering a question on that.
Let's talk a little bit about, real quickly, let's talk about reserves. I don't know how important this is to a lot of you, but it always seems to be one of the bigger items that I'm asked. And what do you do about reserves? Anybody here have a reserve study performed periodically? Or does the board at least perform what's called just a basic reserve fund analysis? I don't think in Texas there's technically a requirement that you have an analysis or even a reserve study. I know in Utah, several years ago, started requiring reserve studies or analyses every 6 years and then an update every 3. Nevada requires them every year. Oregon requires them every year. California requires them. I think Nevada may not be every year. It's like every 3 years. So these are important because as a board, you have a fiduciary responsibility to maintain the property. And if you don't have enough funds to be able to account for that and take care of those maintenance issues as they arise, you're going to have some problems going down the road.
But wait a minute. Some will say, hey, we're paying our bills. We don't want a reserve. And if we need money for something, we're just going to assess $1,500 to every owner, or whatever it is. Because owners don't want to be funding a reserve. They live there for 20 years, funding this reserve. Now it's up to $200, $300, $300,000 or whatever it is. Then you sell. Like, what happened to all that money? Do I get that money back that I've been putting in reserves all this time for the next hurricane? That's what it's declared as what it's for. There hadn't been a hurricane. So now the owner's saying, look, I'd rather just pay as needed.
Yeah, here's the problem with that is what you're doing is you're saddling future owners with the current owner's use and use of the property and the repairs that come as a result. So you're pushing that onto the next owner, and that isn't fair either. That's why it's important to have reserves build up, pay as you go, so that when those reserves have to be, or when those items have to be, taken care of, there will be money in there to take care of it, because the current owners, they're not the ones that incurred these major issues. They happened during the prior owners' period of time. And that's why it's so important to maintain reserves. Now, the question is, how much should you have in reserves? And the National Reserve Study Standards kind of gives us a formula. It's the current cost of replacement times the effective age and useful life. So let's give an example here. Let's say you have a roof replacement that's coming up and it's going to cost you $40,000. You have 4 years left, which is basically a 16-year effective life. So you got 16 years left on this roof. And it has a 20-year useful life. So here's how you would calculate how much you need to put in reserves to be considered fully funded. It would be the $40,000 times the 16 divided by 20 will give you basically $32,000. So if you're to take $32,000, plop it into reserves, you'll be considered fully funded. Okay. Now, there are reserve study specialists out there that will come in and will take a look at your common area components and will assess the useful lives and the current costs and give you everything you need. And they have sophisticated software that will do all the net present value calculations. And then they will say, here's how much you need to put away every month or every year to be able to ensure that you're going to have the funds there available when these different components start to break down, whether it's a boiler or a roof or, whatever replacing your fencing or whatever it is that's going to go into that.
Well, you hit it right there. That board's got to declare what the reserve is meant for.
Yeah.
Is it for that little fence out there?
Absolutely.
Or is it for the next hurricane? I mean, and it's everything in between.
And that's why you'd have a reserve study, or as a board, you'd prepare a reserve analysis. You'd have to list out, take an inventory of all these components, these common area components that you want to reserve for, and identify, okay, what's the replacement cost of this, and this? And then you might have to have an engineer come in and help you out a little bit if you're going to do it yourself. But there's some finance principles here involved. You've got to be able to understand, growth rates and net present value, interest rates, all that kind of stuff. And it's easy you can do it if you've got some really smart, not smart, just financially savvy board member who can go in and run these for you. But if you're not really into that, I highly recommend hiring a third-party reserve study specialist to come in and do this for you. And they can do them fairly, I think, inexpensively, as it relates to your obligation as a board. So it could be worth your while to, consider that. And I don't know what types of common components you have. It may not be.
I think you're way ahead of us.
Yeah.
You're talking to Idaho, man. We're going to sell Hunter Island.
But can I share something from the real estate perspective?
Sure.
The reason why that pay as you play approach towards reserve studies has changed so drastically in the past 5 years, and it's only going to get more aggressive, is lending. So it's not just that they want to see, unless you put 25% down.
10% showing reserves.
Correct. But now in some markets, they're also moving to, they want to see not just your reserves for the emergency set aside. They also would like to see, wait, where's this reserve study that says you need $200,000 roof in 5 years, but you're only collecting enough for 10% reserves, which makes a balance of 100. That assessment that will come could bankrupt some of their lender or their borrowers and force the foreclosure. And that's what they don't want to get themselves tangled up in, is that recession, HOA ownership debacle, where they had to come in and pay all these back assessments. So I, as a broker, had, I'll just tell you, in Colorado, in a ski town last year, I didn't do a single lending deal, not a one. Everyone was cash, and it also brought the sales price down because now it's back to cash paying king. But when it levels out and we do need lenders again in resort areas, they're going to dial into that, not just your reserves, but your reserve study and a plan to fund the reserve study as their basic analysis. And that's painful.
Well, we have definitely a maintenance spreadsheet of everything because you don't know where you're going unless you know where you've been. And so we have that spreadsheet, which the mortgage companies like to see, the insurance companies sure they want to see. And I can do that. I can put numbers to it. But it'll tell you okay, this is the 5-year, 10-year, and you just put a number on there. But again, we don't need an analysis, but I agree with what you're saying.
Nice thing about the reserve analysis or reserve study is you can then go to your board, your owners, and you can say, here's what our future obligation is going to be to repair these items. Here's how funded we are. And if you can say you're 70% or more, you're going to look pretty good. But if you're less than 70%, you're considered to be underfunded. That could create a liability issue for you as a board. And
but again, you still gotta declare what your reserve is for. Like I said, if it's a hurricane and the seawall went in and all the palapas went out and everything, and the whole backyard's out. Well,
that's why it's
70%.
That's why it's important that you do this every year, because these estimates change every year. And so if you're doing that every year, you don't have to have a formal reserve study every year, but if you as a board is at least as part of your annual budgeting cycle, looking at your reserves, looking at your common elements, making sure that you're staying on top of it. You may push some of these repairs out because you find out we may have more life on these items than we thought. Then you'll be able to kind of tweak it as you go. But it's probably one of the most important aspects of managing your HOAs is managing reserves and making sure that you've got enough in there to cover these things. Because the last thing an owner wants is a bill for 20 grand that they've got to do a special assessment because half the property is sloughing off into the sea. I had a timeshare client out in the Oregon coast. Every year they're right on the coast. Their property was sloughing off 10 feet every year. And so they had to go in and put in these huge hydraulic wells to bring the water out onto into the ocean again. And it was a challenge. They had to pass a $2-3 million special assessment.
Now the earthquake got them.
Yeah, maybe, yeah. But fortunately, they spent a lot of money. They got it. Pretty much all their units are now on stilts. And but anyway, it can be a challenge to navigate that. All right. Do you need a reserve study? I think we already talked about this enough. So you as a board, if you have reserves, it's good to have an investment committee. Ensure that those investments that are being set aside or that cash is being set aside for reserves are earning the income necessary to ensure that reserve study is going to be a useful tool.
I have a question.
Yes.
FDIC coverage for reserves. How does that work?
Well, you
You have
can
the reserves in a separate account?
laddered CDs. I mean, you could have all your money in $250,000 CDs spanning different periods of time, depending on what your reserve study projects when those items are going to be retiring. So a number of our HOAs will go in and they'll lock everything up in CDs so that they can get that $250,000 guarantee.
So last question for me. I'm a homeowner and I've been living there for 20 years and I've been putting money in. We never used reserves. Now it's up to $300,000. I'm gonna sell. Hey, I want some of that reserve money back. You never spend it. I've been putting in extra $1,500 every year.
Yeah, but
We get it back.
But the repair obligation is there. It may not be on the books, but it's there. That money's got to be used to repair those common area elements. And once you make that
The
contribution,
reserve is not for repairs. That's not, when we have HOA, we have repairs and maintenance as a line item under your HOA responsibility. Reserves are set aside for an exemption or an exception.
future major repairs and
Future
replacements. Yeah.
Exception that we're surprised, a surprise.
Yeah, I'd need to understand better exactly how you have your.
Well, isn't that everybody's? I mean,
No. The way it should work is that you're setting aside money in a reserve fund to cover future major repairs and replacement expenditures. We're not talking about incidental repairs.
right, well, you said repairs, that's why I was, okay.
There are two types of repairs. There's general repairs and there's future major repairs and replacements.
Future major repairs.
And those are what you're trying to reserve for. And that is why those are the estimates you've got to come up with for future repair and replacement expenditures. All right. I'm running out of time. I think I'm just going to kind of call it here. As far as budgeting goes, budgeting best practices, I'll hustle through this. Let's see. Examine the prior 3 years of actual HOA expenses by line item. Remember that your expenses are what drive the assessment. The expenses are what drive what you need to budget for assessments. And if you find that you don't want to bill your owners more than a certain amount, then you got to cut your expenses. That's how you budget for your operating fund. If you're budgeting for reserves, you should be using a reserve study. You should be using a reserve analysis that actually tells you how much you need to be setting aside each year to cover those future major repairs and replacements. Okay, here's that beneficial ownership information issue. Who wasn't to have the question, what is it? What's it all about? Okay. So there, it's the, what is it called? The transparency, corporate transparency. So there's a beneficial ownership information report, which basically requires that you, to provide transparency, you got to take, aggregate or accumulate information and report it by the 1st of January of 2025, which is coming up here in a few weeks. It applies to most U.S. businesses organized as corporations and LLC, HOAs or corporations. There is currently no carve out for HOAs except those organized under 501c4. I've been dealing with HOAs for over 25 years. I've never seen a 501c HOA before. I know that there are a lot of them in California, but that isn't really what we do. So basically it applies to any HOA that I've ever had to deal with. The filing deadline is January 1st, or within 30 days of formation of the entity. The penalty for noncompliance is $500 per day and may include even criminal penalties. And I think the criminal penalties are like $5,000 or something like that. Dave, you might even know more about that than me, but there's a criminal penalty involved. Sandra, I don't know if you know either, but that could be expensive. The beneficial owner is someone who, number one, owns 25% or more of the company, or two, exercises substantial control over the company. FinCEN expects every reporting entity will have at least one or more beneficial owner. As owners of an HOA, as a body, they're the beneficial owners. They have control of the HOA, right? There's a requirement of each beneficial owner. So you need the full legal name, the date of birth. And I haven't really looked into this, but does that mean that every owner of the HOA We need to pull that information for them.
Just board,
Just the board. Okay.
but it's 5% or more.
Okay. You need a full legal name, date of birth, current residential or business address, unique identifying number, so social security number. But the nice thing is, just this week, the U.S. District Court here in Texas got this case and they said, this is crap. We're not going to require you guys to do this. And it's not just for HOAs, it's for everybody. So it's basically, it had an injunction placed. So there's no requirement right now to comply. That doesn't mean it's a final deal. Who knows what's going to happen? It could be appealed and overturned. We don't know what the status is after that. But as of right now, if you haven't done this, don't spend your Christmas getting this information. Enjoy it with your family and that's all I've got. Any other questions? Yes.
There's a question online, I guess, about the fine. Is the fine against the individual board member or the entire board and association?
I think it's against the board or the association. Yeah, the association. They're the ones that have to file it.
Okay.
All right. With that, I'm going to turn the time over to my partner, who's going to give us some good stuff.
Thank you, Jenna.
You need a break anyway?
Oh, it just.
It said we weren't going to take a break. I was like, okay, you can get up at any time. But I mean, we were shooting to be done at noon, and I don't want to go too much over. Okay, so I'll go through these pretty fast. I'm going to pretend that we put tax essentials at the end because we saved the best for last, but we did it in case we ran out. Because nobody wants to hear about taxes. But we're going to be fast on this. So holler at me if you have any questions. Sorry, it's this one, right? Okay, as an HOA, you do have some options on how to file. John had mentioned, well, I'll start here because I don't want to jump around and I know we're limited on time. But your tax filing options are you can file as an 1120, which is what a corporation files. You can file an 1120H, which is a special corporate filing just for homeowners associations. We're also going to talk about the Texas filing, the Texas franchise requirements, just real briefly. But my goal is not to make you all tax experts. I don't want to be getting resumes for the tax department. I just want to give you some tips on the kinds of questions that you need to ask your tax preparer. So the filing option under Code Section 528 is to file as an 1120H. Under Code Section 277, that's where we get the Form 1120 filing option. John had mentioned 501c4s. Those are rare. Those are usually real estate developers that have a certain part of the development open for the public. We don't see that here. So in making the decision as a tax consultant, when we make the decision on what we're going to file for HOAs, we consider various things. And we do look at it every year on our clients, especially here on the island, because there's we'll talk about some of the special things that they do here. But we look to see if there are any commercial components on the property, because that'll determine whether or not you can file an 1120H.
What is a commercial component?
This is a good example. This used to be a restaurant back in the old days. So it was a commercial component open to the public. So if you have a building or you have, let's say you have your pool open to the public, that can be considered a commercial component. We also have to look at how much of your income is considered exempt function income. And exempt function income is income that gave you the right to be an HOA. So special assessments, regular assessments, anything that gets deposited in your account to further the HOA's existence and to enforce your HOA bylaws and covenants. So if you spend money on an attorney and you get reimbursed for that money by any of your membership, that's still considered exempt function. But you do have to look at it every year. We have clients that one year will do an 1120H, but in another year, it's more beneficial to do a regular 1120. So you want to have your consultants be taking a look at that. So with the 1120H, it's a special section just for HOAs. Nobody but an HOA can file that. But we do have to look at it because we want to be sure that, I mean, the reason it was enacted is because Congress wants to make sure that HOAs are doing what HOAs are supposed to be doing and not using it for, for-profit reasons. And where would that happen? Here out at the island, everybody's into merchandise. Everybody wants to get their merch. You can go to a resort and you can walk into the tiki. I just saw y'all have the wine glasses and the caps. And so you can get merchandise for that HOA. That is not an exempt function income. So you need to be taking a look at income that is exempt versus non-exempt every year. Your HOA dues are usually high enough to where you don't have to worry about that. But we'll cover some instances where it may be an issue. So the advantages to an 1120H, it's short and sweet, not necessarily simple because there are some calculations you have to do. And there is less audit risk. So when we're looking at percentage of returns being audited, 1120Hs are very low. The disadvantages, if you do have taxable income, you're not getting the 21% corporate income tax rate, you're getting a flat 30%. Also, HOAs are not entitled to net operating losses. So if you have a loss in a particular year, you can't carry that forward. And it's not a big deal because if you have income the following year, hopefully it's tax exempt income, so you don't need that loss. This is what it looks like. That's how short it is. All the meat's right in the center. That's the meat of it. And there you see some of the language, exempt function income, and the test you have to meet. Expenditures for that income, the test you have to meet. And then all the gross income and deduction amounts are non-exempt. So the stuff you shouldn't have been doing, but it's okay to do, you just have to report it. And we'll go through those. So some of the guidelines that you have to meet to file this is 60% of your income has to be exempt function income. If all you're collecting is HOA dues and special assessments and late fees, you're not going to have a problem with that. 90% of your expenses have to come from an exempt function. We usually don't have clients that have a problem meeting that. Even if you're selling merchandise, that's usually not a huge amount. You have to be sure that 85% of your square footage is used for residential purposes. So you have to consider event centers. You have to consider, we have in the past have had HOAs that the HOA actually owns some rental units. So those rental units are non-exempt. So you do have to look at what exactly are we using every piece of square footage for. And remember, you can use it for commercial, it just means you cannot file an 1120H. So if you're required to do an 1120, you're taxed just like a regular corporation. It is a longer form. You have your balance sheet that you have to include, and it is the default. When you file a tax return, this is what you're expected to file. Your election to be an HOA is just filing an 1120H. You don't have to file a separate election statement. You just have to file the form. And the second point, just this was enacted because Congress could see us abusing membership organizations to find a place to put non-deductible expenses. There are some advantages to using it because you don't have the 30% tax rate. The 21% tax rate might be more beneficial if you have non-exempt income. I've seen this in cases where we had some big sales or just something very out of the ordinary out here at the island. In smaller HOAs where everybody is really living in the units, it's a different situation. But out here, you have a lot of rentals and a lot of extra extenuating circumstances out here. And every HOA is so different. So we do look at every single one. The disadvantages, the percentage of 1120s that are audited, they're still low. Man, I don't want to scare anybody into thinking that they're going to get audited. But in comparison to an 1120H, higher risk of getting audited with an 1120 versus an 1120H. And the 1120 is longer, has other schedules, a lot of questions to answer, and has the balance sheet component as well. The risk, and I don't remember, I think John mentioned the reserves being taxed. There is a risk of that. Excess member income can be taxed. Prepaids are income in the year that they were paid and can make the member income that is being taxed even higher. There are ways to overcome this risk. This is why it's important to look at this every single year. And because of time, we're not going to go through every single one, but there is a lot of planning that can be done. So you have to have a good consultant that is going to be comparing your 1120 results versus your 1120H results. And that's a question right there that you can just be sure that you're asking. Are we comparing 1120 to 1120H? They may say no because you don't have any extra non-exempt income, and that would be a good answer. But out here at the island, because there are so many different income components, you may want to have them look at it. John covered having your reserves in separate accounts, making sure that, and Danny covered this too. You want to be sure that your reserves and any reserve studies are segregated in the budget. You're talking about them at the board meetings. They're being approved through the board and in the minutes, and you're ratifying everything at an annual meeting. There's a lot of stuff on excess member income being taxed. This gets complicated. We're not going to get into that, but just know that there are ways. If you're filing 1120s and you're having a tax liability, there are ways to help shift income around. And so those are the kind of questions that you need to ask. What else can we do to get the income non-taxable? And yeah, each association should be evaluating their exposure under 277, filing an 1120. The last thing I want to cover is on the state side. HOAs normally don't file with the state, but you cannot just assume that you don't have to. You do have to file for an exemption. So again, you cannot have any commercial activity. Your homeowners have to have 51% of the voting control, and you're used primarily to maintain residential or real estate development. The same way that filing an 1120H is your election to file an 1120H and be taxed as a HOA. You do have to do a filing, separately. You do have to do a separate Texas filing, and it's Form 206. It asks those three questions and wants the basis for the answers. And you answer the three questions in the right here. What kind of property you have, what you're doing, who owns it. Ask for percentages. It's a one-page form, but if you don't file it, Texas is going to be sending you notices. So be sure that that gets filed. It gives you the exemption, and then you don't have to file anything with the state of Texas. If you don't get this done and you do have to file a franchise tax report, rules are a lot easier now. If your gross income is under 2.4, I believe, or 2.7, you don't even have to file a report. You just have to file a public information report that just lets the state know you're still in existence. But you cannot ignore filing it because you will be put on inactive status with the state. Okay, I flew through that and we're only 7 minutes late. But I do want to ask y'all to, in the chat, if you have anything you want to see next year, let us know. We might have to add another half hour next year when we have it. If Danny, if you're going to join us, we'll add another half hour. We have great questions.
You want me to present?
We'll put you down as a speaker. But we hope that you were able to get some clarity on some of the questions that you had. I think there was a lot of good Q&A here. So we appreciate you coming out on a Saturday. We're going to go ahead and end this. And it has nothing to do with the fact that I got to go get ready for the SEC championship. But Dave's already prepared. But thank you for joining us today. We do have cards for our firm, and Wade left his cards here. If you have questions that come up, please let us know. We're also able to help you in any way. We're always looking for good clients, and anything we can do to help you.
So next year, it will be also in December.
In the chat, if you have a recommendation for another time, this was just the only day I think that John and I could be here together. And yes, and hopefully we can still have it here. But we really do want to make this consistent because, I mean, we've all served on boards and board training is important. And I think anything we can do to help our clients and our community, get some education, we're happy to do that. Is there anything else you want to add, John?
No.
You're good? Okay, well, thank you and have a great weekend.